I've been flabbergasted that a lot of traders don't understand why correlations matter in trading. I'll speak to somebody else and they'll say, "Oh, how might I improve the performance of my strategy?" And I'd be like, "Oh, well, let's find out if it's the asset that you're trading, what it's correlated with, and then use those assets correlated with as a way of confirming if a move you're seeing in your asset is a short-term blip or the potential start of a trend." So, for example, if I'm trading the dollar and gold, or use something else. If I'm going to trade, let's go with even the S&P and gold, I might say that it's correlated, let's say, with the US dollar. And I'm saying, okay, if I'm seeing a move that happens in the S&P, but there's no corresponding move inside of the dollar, I might say, well, then I consider this to be a start of a mean reversion move, and I'll short the pop up because the dollar hasn't confirmed that it's falling. Um, that to me is how using correlations in that way helps me to filter out my different trades. So I'll say something like that to somebody, and they'll be like, "Why? I don't understand. Why would the dollar be correlated with the S&P or correlated with gold?" And I'd be like, "Well, you do understand that there's flows of monies within the system, and that one asset, and the reason that they're correlated is that they have certain fundamental components that they share
Mhm.
and that they respond to. And so the correlation is sort of an indication that this is happening, and you can use that in order to help you." And they're like, "Oh, I never even about that before, that correlations between different assets can help me filter out different trades." What kind of conversations do you have, or have you ever had with people? Am I an outlier in your world? Do people understand that correlations matter a lot and they use that in their trading, or is it novel to them?
I think it comes up once you start getting down the path of portfolio management. Like correlation plays, I think, a much larger role there because ultimately, as you're looking for new assets to add to the portfolio to diversify, you really want uncorrelated return streams. You're not looking for the addition of another highly correlated return stream because all you've really done is just doubled the amount of risk that you've already assessed in the portfolio. So if I have SPY in the portfolio and then I go add VOO to it that has 100% correlation to each other, what was the point of adding VOO, right? Like we're looking for something that helps our risk management by giving us something that is uncorrelated to the existing assets in the portfolio so that in times of volatility, that particular asset will behave differently, which should it'll have an impact on your drawdown in the portfolio over the long run. Of course, in times of panic, all correlations go to one, right? We just saw this at the beginning of August with the yen carry trade. Effectively, the whole market panicked and sold off in a very short period of time. And the only market that seemed to benefit from that was the bond market. So then you ask yourself, well, is the bond market a place where I can find uncorrelated returns? And the answer is yes. There's all kinds of uncorrelated return streams that exist in different asset classes that you can add to your overall portfolio that will make a difference in your final return, your absolute returns. I think about this from a trading perspective as well. If I have several different types of trading strategies, I really don't want to run a trading strategy that is highly correlated to another strategy that I'm already running. That correlation is going to show up in a way that if there's any kind of volatility spike in markets, those two are basically going to underperform at the same exact time. I want return streams that are going to behave differently at different points in the market.
Right. Well, so I've as far as correlation, as far as diversification is concerned, for me, I never really think about that anymore because like, I find that everything's correlated to liquidity. But
It's
I
fair.
do like correlations when the asset it's correlated to is offset in time. And so if the correlation shows up, it's a point in correlation between the ISM and gold.
Hmm.
But the one moves, the other one moves 3 months later, 6 months later, 1 year later. Well, then I get a head start. Then I'd be like, okay, there's a trend that's showing up in this data set, and I know it's going to show up in this other one 18 months from now. Let me start making planning my options, planning my positions accordingly. So I very much like assets that way that are correlated through time, and also assets that are correlated with any asset that's inversely correlated, then I could still have, because I really hate being short. I don't like being short anymore. And so being long an inverted asset, inverse correlated asset allows me to be long that other asset when I want to express a bearish sentiment. I feel like I don't have the same sort of risk. Um, so I've built all kinds of different like correlation matrices for myself in order to
Hmm.
survey what's going on in an asset. And until I don't know that I don't know that there's a strategy I've built for myself in the last 2 years where I'm not looking at a correlated asset as a filter to indicate, hey, is this move real or not? I don't
Right.
know that I've ever done that for a couple of years now.
Yeah. No, that makes sense.
All right, so I think I made a correlation matrix for Traders posts that I'm going to be posting soon.
Okay.
It's pretty interesting. Just to belabor this point a little bit more, because I think people who are new entrants into the markets don't necessarily understand that. They get price structure. They get this idea, oh, there's a fractal here and there's a break over here and whatever, but they don't necessarily understand. Okay, but did that break also happen in two other correlated assets? And if it did, well, then maybe now it's more legitimate.